The calendar has turned to June, and that means it's time for my top stocks for the month of June. All of these stocks, all 7 of these stocks, are actually stocks that I own. Some of them I've also added recently, so I'm putting my money where my mouth is. The general theme for this month is that I want to avoid the hype. I think there's a lot of hype in the market. We've just had GameStop pop and drop over the past 24 hours. There's a lot of hype around artificial intelligence. That's just an area I'm going to stay away from for now. I'm happy to buy those stocks during a crash, but I'm looking for value. I'm looking for companies that have a lot of cash on the balance sheet. There's a lot of signs that the economy is getting a little bit weaker. It doesn't look like interest rates are going to come down anytime soon. So I want to have companies that can play offense by having a defensive position. So solid balance sheets, solid profits, solid free cash flow, all that boring stuff that actually makes you a lot of money long term. So let's get into the 7 stocks. My name's Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's start with the first one, and that is Crocs. And Crocs is one of these companies that you're probably familiar with, but may not realize how solid of a company this is. You can see here the company's revenue and free cash flow. Crocs is actually a growth company, particularly the Crocs brand itself. That continues to grow in kind of the mid-single digits range. Where they've struggled a little bit is with their acquisition of Hey Dude. That's why revenue jumped. That's the big jump you see there in revenue. But the slow and steady revenue growth is particularly from the Crocs brand. But there's a couple of things that I like about where Crocs is positioned today. First of all, it's a relatively low cost product and it's a very high margin product. So very cheap to make Crocs shoes, not selling them for a huge price point. So if we do hit some sort of economic turbulence, is Crocs the first thing that you're going to cut back on? Probably not. We're also going to a world where people are buying less fancy, expensive shoes and buying more shoes like Crocs. So it just seems like the world is moving towards the kind of shoes that Crocs makes. That's why you're seeing that slow and steady growth, the very, very strong margins that they have, and the very strong free cash flow. Despite all of these positives, the stock doesn't get a lot of credit from the market. I want to just go through some of the metrics. On an enterprise value to sales multiple, 2.8. So pretty reasonable multiple for a product company. Price to free cash flow is about 12 on a trailing basis. On a forward basis, price to free cash flow is a little over 8 times. So here's a company that is generating a ton of cash, paying down debt. Periodically, they start buying back shares. Just a phenomenal business to own. And I'm not somebody who wears a lot of Crocs shoes, but my kids are now at the age where they're starting to wear Crocs. Starting to see them all over the place. And I'm starting to appreciate the fact that this is a much stickier business and stickier product than I thought it was previously. So I bought shares starting last year, one that I am happy to hold long term. The second stock that I want to go through is Alphabet. Alphabet, there's a lot going on with this company. I think, first of all, the search business is not doing as poorly as a lot of investors thought. Remember when ChatGPT came out and the fear was search is going to die. ChatGPT is going to kill search. That didn't happen. You can see that here in the steady growth of search and other revenue. It's kind of strange how Alphabet reports some of these segments, but I'm going to go through a few of these. The next one shows YouTube, Google, other revenue. So it's kind of a catch-all for all of the other things that are in the business. And then network revenue. All 3 segments are growing really nicely. YouTube and Google since 2017 have been growing at a compound annual growth rate over 20%. So just phenomenal businesses there. Those businesses all roll up into the operating income from Google services. This is the trend for operating income from Google services. You can see up really sharply and doesn't appear to be facing a lot of headwinds from products like ChatGPT. And this gets us to the major growth product that I think that investors really need to keep an eye on with Alphabet. That is the Google Cloud. Google Cloud has been growing at a 41% compound annual growth rate since 2017 and is now profitable. $2.4 billion in operating income over the past 12 months. That should continue. We should see this business be more like a 20 to 25% operating income margin long term. And this is where you're going to get a lot of exposure to artificial intelligence. Google is one of the major clouds building AI tools. So basically that other companies are building on top of. So you're probably familiar with some of the Google products like Gemini. That's the vertical integrated piece of Google. That's where they're building their chips. They have their data centers. They have the products that are actually reaching billions and billions of users. But there's also another piece, and that's what they're selling to other developers where they have their chips, they have NVIDIA chips, they have data centers, and they have APIs you can build on top of different models you can choose from. But they're providing the infrastructure layer for artificial intelligence, and then other developers are building on top of that. So I think this is going to be a huge tailwind for them. Alphabet is actually really well positioned because they invented a lot of this artificial intelligence technology. So this may not be the hottest name in AI, but it may be a relatively slow and steady, still very, very fast growth for a technology company, but it's not going to be growing at 100% a year. It's going to be growing more like 20, 30% a year, but that may happen for a decade. So I think there's a lot of tailwinds behind the Google Cloud. So a lot to like there, and the valuation is pretty reasonable. Price to free cash flow on a trailing basis is 31. Talked about those margins are actually getting a little bit better. So price to free cash flow on a forward basis is a little under 27. So not the cheapest stock, but also one of the stickier companies that you're going to find in technology. And I think all those businesses are moving in the right direction. We haven't even talked about Waymo, which is another product that I think could disrupt transportation, but that's really a free option that investors get when you invest in Alphabet. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. The next stock on the list is Airbnb. Airbnb is one of these companies I think you can just set it and forget it for the next decade. A wonderful business in a two-sided market. So they're a marketplace that's providing service to hosts and then also a service to users on the platform. So this is a perfect platform business where they're just providing that connection. They're not actually taking a lot of risk by buying properties like a hotel company might do. And you can see here, revenue has just been growing like crazy. And a lot of the cost cuts that they put in place during the pandemic have really helped their operating margin. That's why you're seeing such strong net income from the business. But there's a hidden benefit in Airbnb's business and the way that it operates. So when you sign up for an Airbnb, let's say you're taking a trip 6 months from now, you're going to pay for that trip right now. Let's say it's $1,000 that you're going to spend on Airbnb, that you're going to be charged that $1,000. Airbnb is going to hold that $1,000 until you actually complete your stay. That's when that money is going to be transferred to the host. In the meantime, Airbnb gets to keep that cash on its balance sheet and gets to generate interest income from that cash. So they not only have their own cash on the balance sheet, they also have customers' cash. In total, that's nearly $20 billion worth of cash that's sitting on the balance sheet. And you can see that this is now generating a very significant amount of interest income, $777 million over the past 12 months. This is because of Airbnb's reverse cash conversion cycle that I talked about earlier. So as they grow, they actually have more cash on the balance sheet, not less. So just a phenomenal feature in the business. Now, Airbnb has reached scale in a lot of places, particularly in the US. So they're talking about expanding into international markets. That's going to be a slow tailwind behind the company. But where I think there's a lot of optionality for Airbnb is actually in what they call becoming your travel concierge. So in the future, do you just talk to Airbnb and say, hey, you know what? I have a family of 4. I want to take a trip to a warm location and we want to have some activities each day. And they line up all these things for you. I think that's where Airbnb as an application layer could be in a really, really solid position with some of these artificial intelligence tools. So right now they have locations that you're going to stay at, homes, apartments, condos. The next thing that they're already starting to add is experiences. So that's going to be kind of the next vertical. And they have talked about adding multiple more verticals. Maybe that's air travel. Maybe that's on-ground transportation. We're not sure exactly what that's going to look like in the future, but this is a company that probably has a very long growth runway ahead. Only about 1 out of every 10 stays in the US is at an Airbnb, so that gives you a lot of opportunity for growth. And the stock's pretty reasonable today. Price to free cash flow is 22 on a trailing basis. On a forward basis, about 24. Investors have gotten a little bit worried that growth is slowing a little bit as the company matures and we kind of exit this pandemic period. But there's going to be volatility in a company like Airbnb. When I think about, do I want to just own this stock for the next decade? The answer for Airbnb is absolutely yes. I think there's a ton of tailwinds behind the company. Brian Chesky is one of the visionary CEOs that we have in the public markets today. So love Airbnb and where they're sitting. I think this is just a stock you can hold for the next decade and do extremely well. The next company is SoFi, the digital bank. And I love where SoFi is positioned today. So as a lot of the traditional banks have gotten themselves into trouble buying things like treasuries, which now have much lower valuations than they used to, aren't generating all that much cash, they can't actually pay very strong interest rates to customers to have their deposits, whether it's a checking account or a savings account, in traditional banks. At the same time, a lot of those traditional banks are leaning into their physical infrastructure. This is one of the strange things I've seen around me, is companies, major banks, building more bank branches. I'm not really sure why we're building more bank branches when we're moving to a digital world, a digital banking world. And that's where SoFi is really leading the way. And this chart, I think, really shows the strength in the company's business. The lending revenue is really what I call the Trojan horse for SoFi. It allows them to get into the industry, the personal loans, the student loans that SoFi has given to customers are not the typical kind of loans that big banks want to get involved with. They would much rather write a big check for a commercial real estate property, for example. So that was their foot in the door, but they've actually been pretty conservative in that lending, and that's why you're starting to see that growth kind of slow down. But now the growth driver is the technology platform and financial services revenue. So you can have your investments on SoFi. If you're a corporation and you want to offer banking solutions, you can do that with SoFi's technology platform. There's a lot of different ways that the company is going to be able to grow on the back of the technology that they have already built. And this is really the disruptive piece of SoFi, is that they are a technology company that also happens to be a bank. And there's no physical infrastructure. They can basically grow indefinitely. And I think this is the place to be in the future of finance. We're not going to be using banks in the way that we have traditionally. And so I think those companies are going to slow, where they're going to be hampered by those low interest rates that they're going to be able to pay because of the unrealized losses that they have on the balance sheet. SoFi doesn't have the same kind of losses on the balance sheet. Their loans are much shorter. Yes, they're now getting into things like mortgages, but they're selling a lot of that risk to investors. So I love where SoFi is sitting. Phenomenal growth stock. It's also now profitable, and from a valuation perspective, price to book value is about 1.2. So not the most expensive for a bank stock, but you're actually getting a technology company at the same time. So I think that is really attractive for investors if they continue to grow at this rate, particularly on the financial services side and the technology side. This will be a home run for long-term investors. The next stock is General Motors. I know this won't be the most popular stock, but actually General Motors has outperformed Tesla by a wide margin over the past year. GM stock is up 33% and Tesla stock is down 18% over that period of time. Why is that the case? GM is still generating a massive amount of free cash flow. So as Tesla's margins have fallen because competition is coming into the EV space, competition is actually leaving the truck and SUV space. That's where General Motors generates a vast majority of its money, still generating nearly $10 billion in free cash flow, expecting to do about that again in 2024. What are they doing with that cash? They're buying back stock at an insanely quick pace. They did a buyback late in 2023 that was nearly 20% of the shares outstanding. They're continuing those buybacks in 2024. So as the company generates free cash flow, which I think they're going to continue to do for the foreseeable future, they make that transition to electric vehicles. So you broaden out the market. And then the real upside for investors, this is where the asymmetric opportunity comes in, is with Cruise. Cruise has had challenges over the last 6 to 9 months, but they're now back on the roads. They're mapping in their second city, starting in Phoenix, now in Dallas. So we're going to start to see commercial operations from Cruise picking up. That provides potential growth tailwind from that ride-sharing service. And I think long-term, that could be an incredibly big and profitable business for General Motors. Will probably eventually be a separate company. But GM owns a vast majority, about 80% of Cruise, and you're basically getting it for free. Right now, shares of General Motors are trading for a 5.6 price to earnings multiple on a trailing basis. On a forward basis, the price to earnings multiple is 4.8. 4.8. So that means if they just use the earnings that they're earning each year, they could buy back about 20% of the shares outstanding. Now, there will be volatility in results. Free cash flow may drop a little bit if the economy gets a little bit worse, if interest rates go up. This is not a business that's going to just grow in a straight line. But when you're getting that kind of value and that kind of upside with a stock like with a business like Cruise, that is why this is one of my top stocks for the month and one of the ones that I have been adding over the past year. The next stock is a similar story, and that's MGM Resorts. So this is another cash flow business, buying back stock, trading at a reasonable value. Let's look at the company's adjusted EBITDA from each of their segments. In gold, you see the Las Vegas Strip. You can see that there's a massive jump in Las Vegas Strip adjusted EBITDA. That's because after the pandemic, the gambling revenue in that region actually overshot what the region was doing pre-pandemic. So people are spending more money in Las Vegas today than they were in 2018, 2019. The same thing, although to a slightly lesser extent, happened in regional casinos. The one area that is just now starting to recover is Macau, which in this chart is shown as MGM China. But you add all of this together, and the company is generating $5.3 billion in adjusted EBITDA over the past 12 months. Like General Motors, what MGM is doing with that cash is buying back a ton of its own stock. And the stock is a pretty reasonable value. The market cap, as I'm recording, $12.6 billion. There's about $3 billion worth of net debt on the balance sheet. So debt minus the cash that's on the balance sheet. And like I talked about, there's almost $5 billion in cash coming from the business. If you can buy back stock at that kind of valuation, that is just a really attractive place to be. And I don't see Las Vegas or regional casinos going anywhere because this is a supply constrained market. And that's why they continue to grow year after year. The other thing to consider is that they have a casino being built in Japan right now, a $10 billion casino that could be one of the most profitable in the world when it opens in 2030. So that's another growth avenue that MGM has up its sleeve. I love where MGM is positioned. I love the price that we're getting for investors. And this is now not a business that's really high risk like it was during the 90s and 2000s. This is now a cash flow business. We should judge MGM Resorts on its cash flow, how quickly it's buying back stock, is it paying a dividend? And from that perspective, I think this is an incredibly good value for investors. The final stock of these 7 on my list today is Disney. Now, Disney is another one that hasn't been particularly popular with investors, but I think is really well positioned. First, your baseline for Disney is you have the parks and entertainment business, just incredibly profitable and generating strong operating income and cash flow. You can see here that operating income from parks and experiences alone is nearly $10 billion. So that alone is a really solid business. For a company trading for an enterprise value of about $230 billion, that would maybe be an expensive stock, but wouldn't be crazily valued. But that's not all there is to Disney. You also have the entertainment business, which for as much grief as Disney has gotten for going into the streaming business, this is actually still a profitable business. ESPN is still profitable despite the fact that they've lost about 40% of their subscribers over the last decade. Isn't as profitable as it used to be, and that's what investors are worried about. But as that linear TV business declines, this streaming business is growing at an incredibly rapid rate. I did a video on this recently, but I think by 2026 or so, Disney's streaming business is going to be bigger than Netflix on a revenue perspective. Now, probably isn't going to have the same margins yet, but very well positioned with Disney Plus, bundling with Hulu, bundling with ESPN over the top in 2025 when that launches, and now recently announced a deal to bundle with Max as well. So now you're having your own mini cable bundle on streaming with a ton of content there, a little something for everybody, kids, adults, sports fans. And that streaming business just got to profitability last quarter. So we're only starting to see the momentum of some of the cost cuts that they put in place, some of the content changes they made, and some of the growth and bundling that has been taking place at Disney. Long term, I think this is a really well-positioned business. The parks business is just going to continue to steadily grow year after year. It's going to be a cash flow machine, but the long-term growth is in that streaming business. I think there's only going to be 1 or 2 winners in streaming. I think it's going to be Netflix. I think it's going to be Disney. And Disney has a better breadth of content. You have that tentpole content with content from Star Wars, Pixar, Marvel, the Disney Studios. Then you have sports content. They're going to have way more sports content than Netflix possibly could for the next decade, given all of the deals they've signed with the NBA, with college football, with the NFL. So that puts them in a really good position, and now starting to bundle to build out some of that other content in general entertainment as well. So love where Disney is positioned. Stock is pretty reasonably valued. Price to free cash flow is 22. On a forward basis, it's 21. I think that's probably underestimating the potential for the business, but Disney is investing a lot in not only streaming, but also $60 billion in parks over the next decade. So Disney, maybe a little bit unloved by the market, but I think very well positioned for the future of entertainment. So those are my 7 stocks for the month of June. Which one of those is your favorite? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.